I simply wanted to introduce you to our first speaker, although I hope at least all of you know him already. Michael made some small remark also regarding Volker Wieland. Volker holds the endowed chair of monetary economics at the IMFS, the Institute of Monetary and Financial Stability, which is one of the engagements of the foundation. Since 2012, although he already is professor at Goethe University Frankfurt since 2000. He holds a degree, a PhD from Stanford University, and worked at the Federal Reserve Board before he went to Frankfurt. We both know each other for several years. We worked 8 years together at the German Council of Economic Experts. We are also in other circles sitting together discussing the whole time. So I'm very much looking forward to Volker's presentation and to Volker's talk. So it's your turn.
Okay, thank you very much. Wow, this is pretty loud. Can we tune that down, or is it too loud? Okay, well, thank you very much for the invitation. I'm very happy to be here and see so many well-known faces, colleagues and friends. If you expected me at this occasion to bring a very sophisticated model-based quantitative analysis, unfortunately this time I have to disappoint you. So although I'm happy to do that in the future again, or have done it in the past with some of you here, also as I see Gernot Müller sitting back there, who was instrumental also in getting our macro model base going, right? And actually before, maybe one more word, I was just sitting because you were talking about the COVID crisis and that we're so delighted to meet again. And I was sitting the other day with Matthias Trabant, who is a colleague of mine, a recent colleague in Frankfurt, and with a team of students also from the IMFS or young researchers. And Matthias starting our meeting by saying, oh, it's great that Corona is getting more attention again, right, in the media. So that's an odd statement, but to give you the background, we were putting together, or we're still putting together, and in different forms, a database of so-called macro epidemic models. And we're just getting ready to, by end of July or mid-July, to launch an update where you have a macro epi model database, which is already operational, but bringing it to the next level. So today, I will just contribute some current analysis, and not sophisticated, but hopefully, nevertheless, at least topical. If you can bring it up for me, that'd be great. And I'm delighted that I have two discussants, and I hope, I apologize already for sending you at least the third of 3 sources I'm drawing on only this week. So the topic, or the title I chose, was Public Debt, Inflation and Central Bank Independence, Quo Vadis Euro. And there's an overview, but it has 7 points, so let's jump, it's too long. Basically, it draws on 3 sources. One was the second chapter of our annual report of the German Council of Economic Experts in November 2021 about normalizing monetary and fiscal policy after the coronavirus crisis. And that's a moving target. In February, I thought, well, now we know exactly what happened and how to go forward. And I was asked to do a report for the European Parliament, for the Committee of Economic and Monetary Affairs, on how economies responded and growth trajectories, debt sustainability in particular, and best practices. And then the recent paper updates some of the calculations in there. So we had some recent news both from the European Commission and the European Central Bank. The news from the ECB, you probably know. The news for the European Commission, they produce so many reports and they're so thick, so that you probably missed it. But so let me start with that. In April 2022, the European Commission actually published its fiscal sustainability report. They do that regularly. I haven't actually looked at that very much, but fortunately I looked at it in April, and they basically said medium-term debt sustainability risk is high in large member states. Here, the conclusion of the very thick report at the start by the Director of General Economic and Financial Affairs, he says the FSR 2021 shows the presence of fiscal sustainability risks in several countries, calling so that sounds pretty dramatic, fiscal sustainable risks, calling once economic conditions allow, I don't know what that means, so at some other point, for prudent fiscal policies. So then I asked myself, what's prudent? Don't you always do prudent fiscal policies? Or am I doing imprudent fiscal policies? So it's kind of running up and then lets you sit there. So maybe there's a political dimension between how these summaries are, concerning how these summaries are formulated. So I said, okay, right? There are different ways of saying okay, right? You could say okay, 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 okay. It's not so clear what it means. So here is the type of pictures you see in that report. They have a lot of red. Right? So a lot of red. Red used to be my favorite color. It still is. But anyway, so when I play a board game, I always choose red. But anyway, so for these reports, red is not a good color, right? They want to signal stop, high, medium, and medium and long-term high fiscal sustainability risks. Let me not go into Italy, but that's let me not go into is in detail, but it is about Italy. Sorry, Lucrezia. No, we are in Tuscany of Germany, you said, right? I mistakenly said Sicily, but of course Tuscany, right? Yeah, but anyway, so that's why, right? But also France, it looks the same in the report. So it's not partial about Italy. And Spain does not look that much better, but also high, so there's different types of analyses, adverse R minus G scenario, etc. Stochastic debt sustainability analysis. Actually, some years ago, Olivier Blanchard recommended that this type of analysis should be the basis for, in place of the fiscal rules, basically conduct this analysis for every country, and then we figure out something. But you see that is also pretty complicated and lots of stuff I can't go into. But the red I thought memorable. One thing I thought particularly interesting, they do very much buried in the big thick volume some analysis about the risk. What if they have an adverse R minus G scenario? So the real interest rate or the long-term real interest rate being below growth. That's what we experienced over the last decade or so, and that really made it easy to carry large government debt or large debt to GDP ratios. And so they look at the risk of just raising this by, I think, 1%. So the interest rate being higher, but not growth. So the differential being 1% smaller. In that already you can see would result, the red being a substantial increase in the next 10 years of the debt to GDP ratios. Over to the ECB, and they already had an unscheduled, I was almost said emergency meeting. That's how it came across, but I guess it's just an unscheduled meeting. Because at an emergency meeting, you would have expected a very, something very significant or new, but what we heard is what we heard before. They want to act against resurgent fragmentation risks. And they said, well, they will apply flexibility in reinvesting redemptions coming due in the PEP, Pandemic Emergency Purchase Program portfolio. But they've said that before. And also, what does this all mean? I don't know. We'll have to talk about that. But they say, well, this is important for the functioning of the monetary policy transmission. But this was not new. I mean, on June 9th, President Lagarde said the same thing. And in addition, they decided to mandate the relevant Eurosystem committees together with the ECB services to accelerate the completion of the design of a new anti-fragmentation, like Microsoft used to have that, defragmentation, right?
What do they mean with fragmentation?
Yeah, I don't know, we'll come into that. At this point, I just want to, and you can interrupt me, that's great. Just you have to stop me at the right time. So, but that Lars will do that. But what this sentence says is basically they're publicly telling their staff to really get to work faster. Yeah, I would have thought you could have a direct channel to talk to the staff. Anyway, so they want to complete, but they also talked about designing, I mean, also on June 9th, President Lagarde said that they are also can look at new instruments. The new instruments, from what I could find out, it's nothing complicated. It's just a new purchase program with the difference of buying selectively just one country's debt or another country's debt, kind of like the OMT, which we already know, the outright multi-transactions. Okay, so but that, to me it sounded like, wait, there's an emergency. I keep getting now questions from media again, even though I stopped being a member of this council, right? And they asked me if there's another euro crisis coming. But I think it had a lot to do, not with the report from the European Commission about fiscal sustainability risks, but with this unscheduled meeting. Maybe others will say more about that. But so let me quickly say first, where do we come from? We come from low inflation, low interest rates, rising debt, and declining interest expenditure. So here you just have a picture you're very familiar with, right? The decline here in long-term interest rates over many years, here for Germany, France, Italy, and Spain. And at the same time, the decline of policy rates. This was possible because inflation was very low. And this actually our shadow rates measuring some of the additional purchase programs, like the impact on, and translating the impact of that in an equivalent rate. During this period, debt to GDP ratios actually kept rising. So this is, again, Germany, France, Italy, and Spain. And we have Italy stabilizing kind of after the debt crisis and then rising with the Corona crisis. France, in orange here, actually still rising, 2013 to 2019, the debt to GDP ratio rising. And then, of course, in a crisis, you want to borrow. Makes a lot of sense. But in times between, in times of recovery and growth, ideally they should decline, right? So that didn't happen. It happened in Germany, it happened in Holland, Austria, so there are some countries where they reduced debt to GDP, but not in some of the other large countries. At the same time, however, interest expenditure as a share of total expenditure, but also as a share of GDP, kept going down because either countries like Germany already enjoyed relatively low rates and enjoyed even lower rates, negative rates. Countries such as Italy, Spain, after the euro debt crisis, could start substituting the high interest rate debt with lower interest rate debt. So basically, even though the debt to GDP increased, it seemed very easy to bear the cost because it was coming down, right, as a share of total costs. And so some people were starting to worry about maybe in the future debt to GDP ratios declining too quickly, right? And so they said we have to, in all countries, even Italy, we have to keep up deficits or have bigger deficits so they don't decline too quickly. That fortunately did not happen. So that concern we can safely lay aside for now because other things happened. So at least in 2021, things still seem fairly benign. Here you see the 10-year government debt yields hadn't risen that much. Inflation, as you know, throughout 2021 started rising, and some, including the ECB, were believing still at this point that it would rapidly come down. Unfortunately, that did not happen. What happened was it kept rising even before the Russia-Ukraine war, but even more so now. Here you see again Germany, France, Italy, Spain, and here government bond yields have been rising very rapidly. So this whole question of what's the interest expenditure countries have to carry, can they pay for that? What's the future in terms of debt sustainability has assumed a new dimension. This came quickly. So for example, we are very happy to have ECB President Lagarde at the ECB Watchers Conference, also an activity of our institute in March. And at that time she said, well, the ECB staff baseline projections, which include a first assessment of the impact of the war expect on average 5.1%. In a more severe, in a kind of extreme scenario, 7%. A very different picture from what the ECB was talking about until November 2021, but still, the newspaper was saying in an extreme worst case scenario 7%. Well, actually we're there already. The outlook has changed. We need to change policy, or not we. Oops. It's a me?
I don't know.
Okay. Too many mics. So we are already at 7%, 8% even month by month. The ECB is now forecasting 6.8% for this year, and we could also turn this mic off,
He's fixing it.
Because I can probably speak loud enough so you can hear me. No? Okay, so let me speak up a little bit. So maybe it's too many mics here. So that's the situation. So their expectations have moved up a lot. Here is just the expectation of inflation for 3 major economies, Euro area, US, and UK. We'll be hearing what UPIL has to say. Dramatic move up. These are expectations over the next 3 years. So this is a much more sustained development, not a temporary development. And since then, markets are expecting very rapid tightening. In some countries here, the US and the UK, there's been already substantial tightening, but more to come if markets are right. And even in the ECB, by next year, markets currently expect 2.5%. So the ECB has a long way to go and very little time to get there. That's at least what the markets think at this point, or what you can calculate from derivatives. And throughout this period, of course, yield curves have shifted up. Here you can see that for the 4 countries I'm focusing on, Germany until, this is from August, so the green here is from August 2021. So negative rates all the way up to a 30-year maturity. So here we can see the years. This changed. So Italy at that time already was paying a premium, also Spain. But still, rates reaching 1.5%. Here for Spain, below 1%. By January, that was already up basically 50 basis points for all 4 countries. By February, so before the orange line, so before the Russia-Ukraine war, it was up another 50 basis points. And then since the war, it shifted up. And since the recognition that inflation has really broadened and it's not a temporary phenomenon, it's not just energy prices, it has shifted up much more. So now Italy reaches here, this is as of June 2nd, so it's shifted up even a bit more. There was more movement, but so beginning of June up to, say, 3.5% here. Spain up to 3%, between 2 and 3%, and if we jump back for Germany up to 1.5. So if this is a safe rate, you could say, well, now we're safely, according to what some think is an equilibrium nominal rate of 1.5%, but that may not be what the future holds. But anyway, that's here. France, Italy, and Spain paying some premium, some spread over Germany. So that's what happened recently. And one question I'm looking at, or we've looked at throughout these reports, and we're looking at again currently with Veronika Grimm from the Council and Lukas Nö, is, well, what does it mean for the cost of debt? So there are some simple calculations, nothing fancy, no model, but I think it's interesting. So we try to do this relatively thoroughly. First, let's take a picture at the interest expenditure. So in Germany here, in France, in 2021, in Italy, in Spain, we're going to look at the central government. So in Germany, that means we're just going to look at half the debt. The orange is the other entities, the states and Social Security, etc. And here, but for France, Italy, and Spain, central government is the big chunk, is the biggest amount. Here you see the average maturity. That's an interesting development. Over the years, the average maturity of the debt has lengthened. So certainly the interest cost of governments not only has come down, but it's also become less sensitive to rapid changes in interest rates. So that's a good thing. Even though debt to GDP ratios have not come down for 3 of these 4 countries, but have gone up. At least the maturity. Now, we look at, okay, let's calculate if they keep that constant, if they keep this debt to GDP ratio as we have it now constant, which means that grows with GDP, let's try to estimate the development of the interest cost, of the interest expenditure of governments. That's basically the exercise here. And so we want to see how this expenditure as a share of GDP will develop over the next 10 years. Is it basically right that we should be very concerned that countries may not be able to carry the debt? And if so, what actions should they take? Maybe they should act quickly. So one of the things going into the calculation is, of course, the future redemption payments, which you already know. And one thing which is interesting to see here, that's why I put the picture in for Italy and Spain, it's still the case that some of the debt which is coming due carries high coupons. So light blue is above 5%. So that would still be higher than what they pay this day if they newly issue debt, right? So a lot of the redemptions are are from lower rates, but also a good bit from higher rates. That's another element here. And so if we look at the interest projections, we then calculate under a number of assumptions. The assumptions, okay, I haven't fit them in the slide, so they're a little bit down here. Basically, we assume that the yield curve from different situations. There are 4 different scenarios. The yield curve from last year, when things were looking very benign. The yield curve from June 2nd. And then June 2nd plus 1 percentage point shifted up, but phased in every year 50 basis points. So there's a phase in. And then, so it takes 2 years to shift up to 1 percentage point. And then the other scenario is taking 2 years to shift up 4 years to shift up 2 percentage points. Right? So that's the 4 scenarios in terms of interest rates. And then we want to look at how does the interest expenditure develop relative to GDP. And we assume, of course, you need to have assumptions about the maturity structure. So we assume that stays fixed at the level we observed in 2018. I showed you this before in the chart. You need some assumption on how much more new debt countries will incur. So here we just assume that they will keep the debt to GDP ratio fixed, which means that the debt grows but at the same rate as GDP. Right? So, and under those assumptions, yes?
When do you get the nominal GDP?
And the nominal GDP forecast is the April IMF forecast. Yeah. So you divide the nominal interest payments through the nominal GDP. And so you need a GDP forecast. Yes. So that's the most recent forecast available. So basically another way means that if we shift up the yield curve without changing the GDP forecast, it basically means that the R minus G differential changes. Right? It's an adverse. So it's very similar in a sense to these adverse movements of R minus G, which the Commission looked at in terms of simulations. Okay, so what does the data look like? Well, this seems to be history. So this development, which looked very beneficial. Okay, one thing, for Germany, of course, you need to keep in mind it's only 50% of the debt. So if we pay here, 0 point something as a percent of GDP, it's probably double because it includes the lender, etc. are not included. So what about France? Also, so in August, the projection would have been it comes down even for Italy, right? Remember, so very rapid decline. That was the perception last summer of still last summer of very rapid decline of interest rate costs from 3%, 3.5% to 1% of GDP. Same in Spain. Yeah.
If I got you right, you ignore that inflation went up.
Sorry.
You ignore that inflation went up for the graph. Is that what you said?
No, inflation is no. We didn't ignore. We for the graph, you need to have nominal GDP and you have nominal interest expenditure.
GDP prediction for this year would be plus 8%.
So the nominal GDP is the nominal GDP.
Yes.
Now, when you look at inflation, of course, what I showed you before is the consumer prices. So for nominal GDP, what will matter is the GDP deflator. Right, that's in there. Right? So that's a different measure. So what's in there is basically the forecast as of April, yes, of nominal GDP.
That would be for this year like plus 10%.
I don't know what I don't know offhand. We would have to look back. Yeah, but it's the increase of nominal GDP the IMF expects. Yeah. So inflation is in there, but not to the same extent as the 8% you see on consumer prices, right? And not to the extent that maybe there's a change between April and June. But then, of course, if your forecast for inflation changed between April and June, but probably for your forecast for GDP went in the other direction. So I think even if we had a June forecast to use here, it's probably not that different, right?
But I guess what Christian is saying, that the yield curve doesn't incorporate that high inflation as an inflation expectation. It's just a mechanical increase in the yield curve that you have here.
Yeah, so the yield curve as of June incorporates it. So we'll come to that. So the August yield curve, of course, does not. Right? Was that the question? Okay.
No, the question is that did we really see an increase in real rate expectations so much as this graph suggests, or is there something? Because that must be behind it, right? That real rate.
Well, let's come back to that. Let's first look at what that is. So this here, from blue to orange, would be the shift in the forecast for the interest rate, right? Plus using the current April dated GDP forecast. So that shift is pretty clear, right? These blue and orange are just mechanical shifts up in the interest rate alone, none of the other factors, right? So, but in August, of course, we used the August forecast when we did this, right? At least when we did it the first time. I'll have to check that it hasn't been updated, right? It depends how it's a slightly different exercise if you mix the August yield curve with the April forecast. But in any case, you see, we still have now, so we don't have this decline anymore, so that's gone. That's what I meant when I said, well, low rates, the fear of declining interest expenditure, that's history, right? So if you use the orange line, if you use the current yield curve with the current nominal GDP forecast, but what you can still expect is basically a stabilization of interest expenditure according to this calculation, if the governments act to stabilize, to keep constant the debt to GDP ratio. So hold on, let me just quickly show the Italian, and then we can go through more questions. So this was Italy. So okay, so Germany, France was here, and now. So I think if you look at these countries, if you look at France, with a 1% shift up, it goes to 2%. With a 2 percentage point shift up, it goes between 2 and 3% of GDP in terms of total interest expenditure. This is, in a sense, an adverse movement of interest rates versus growth, because the growth forecast is not adjusted along with the shift up of the yield curve. But you could say, well, that's manageable. For Italy and Spain, at least once you have a 2 percentage point shift up, you would get developments which are breaching the costs you had in the Euro debt crisis, right? So this would eventually, in the medium term, looks quite worrisome. Okay, now let me take Ottmar and Mirko.
You showed a graph where the high yield bonds get mature within the next 1-2 years.
Yeah.
And even with the present rise in interest rates, the situation of Italy should improve.
With the present, it's basically flat, right? So the orange line, the blue is the improvement as it looked last summer. Yeah, but with the orange line, it's basically flattening, right? Because yeah. So you have some. You remember, look at the redemptions. The redemptions is part of it. Some of the redemptions are basically below rates, and some are above, right? And so what comes when you, so I made the point that, say, the blue ones, there are still some in there which help you. How it averages out depends on the calculation. You can not see it immediately here. Yeah, no, the orange is also there, right? And plus, there is an assumption that you don't just have, you don't keep the same debt level. Here, the assumption in the calculation is that you keep increasing the debt level along with GDP, right? So just as a benchmark. I think it makes more sense to have a declining debt to GDP ratio. But still, I thought it was remarkable that still, even at this level, they would be able to maintain the interest expenditure per GDP, right? So if you just look at the orange line, it's like saying, you might be tempted to say to the ECB, why do you rock the boat? I mean, what's the problem of paying basically the same share of interest of total GDP in terms of interest, right? Which for Italy would be a bit more than 3%, for Spain a bit more than 2%. So, Mirko.
Yeah, I just wanted to rephrase Christian's question. So I guess what you're doing is you're moving around the numerator in these scenarios, but you're holding constant the denominator. How that's how mechanical.
That's a mechanical shift if you look at the blue. And so this is basically a projection based on the current forecast and the current yield curve. And then we just change exactly the numerator. Yeah.
If you just change the numerator, it's a bit the question, how do you interpret that?
Exactly.
What is it actually that only shifts the numerator or doesn't shift the denominator? I think that's a way to rephrase Christian.
Yeah. No, that's what I meant with, so it's a basically mechanical exercise. Now, if you would use a model, maybe you would have to have some mechanism of changing both. But basically what this means is if growth, so for example, interest rates, so people were wondering about why have interest rates been so low. One of the potential reasons is that GDP growth, potential GDP growth declined, right? Productivity growth declined. So if you think, well, the equilibrium rate moves up because our potential growth outlook improves, right, then both the numerator and denominator would shift up, right? And not much would change. So this would be a kind of scenario which is more consistent with the idea that the differential between, in this case, potential growth and the interest rates, the equilibrium interest rate, goes against you. And so that's why I made this allusion initially. It's not the same, but it has the same flavor, particularly when you go to, say, 2 percentage points, right? It has the same flavor as this moving against you, right? And so in that sense, I think if you see that, it's coming up over time. It's not coming up tomorrow. It's not like tomorrow. It's, of course, part of the reason it's not coming up tomorrow because there's a phase in. We only phase that shift in. But still, also because you have the rollover of higher interest rate debt. And so you have some time. So the message, maybe we'll come back to questions in a moment, but the message would be countries should act to basically get on a course and a trajectory where debt to GDP ratios are declining. So you actually establish a safety margin against any kind of risk. But per se, at least the baseline calculation doesn't suggest that now the ECB should step to the plate and buy lots of the debt. But anyway, so there's another question, Lucrezia. But you get to talk in a moment.
We're going to have a discussion after.
Okay, so let me jump there. A few other issues to keep in mind where you could say the costs are different from what we calculate. First of all, there are a significant share of inflation and interest-linked bonds. I didn't realize that until recently. So, for example, here in France, right, you have 12% of inflation-linked bonds. In Italy, there are interest-linked bonds and inflation-linked bonds, and you see the inflation-linked bonds also going up to 12%. So maybe that was cheap funding when there's low inflation time, but that funding has become very expensive now. So if you jump back, if you look at the interest expenditure chart. Where was that? You saw here there was a little blip up last year. So this may very well be related. Right? Can you see that on the back? It's moving up a little from 2020 to 2021. So one of the reasons may very well be the significant share of inflation-linked debt. So that's turning very expensive. It's still a small share, but oh well. So what's helping you? We talked about the maturity. Another thing which is helping, a lot of this debt is not out of the market. So the central banks have bought up for Italy 25% and the Netherlands 45% of total public debt is basically, in economic terms, monetized, right? It's monetary financing in economic terms. Whether it's illegal is another question, and whether with the treaties, but it's certainly financed now. It's residing in the central bank balance sheet, and the interest. And so, what matters is really not this interest rate on the bonds, but the interest rate paid by the ECB, which is very low compared to what Italy pays. So the Italian central bank basically kicks that back as a profit at the end of the year. That's how the system works, because the risk, at least on most of these balances, the risk and the benefit is not shared, but it goes to individual countries. For Germany, of course, it's the other way around. It looks like funding is very cheap at low, so maybe Lars, who's in close contact with the finance ministry, knows a lot more about that, but it only looks for the finance ministry like negative rates. But of course, if it's monetized at 0 rates or something like that, it's not quite as cheap, and the Bundesbank does not kick back a profit. So yes, it looks like they could easily carry that cost of debt. If you consider some mechanical shifts, you can get worried, at least in the medium term, which is good, because I think there needs to be an action. Large share of the debt is already monetized, so that maybe helps you in the transition. That shouldn't be a reason to now go the other way. So central banks, so the rest, I have 5 minutes? Less than 5 minutes. Okay, so it's just some quotes. You guys had questions already, so I get some of the Q&A period. But anyway, so I think some people, many of you do very sophisticated work with models, and maybe you think of a game theoretic model of fiscal dominance and different players, and they have different interests, the central bank and the finance minister. I'm going to do a very low-key version of that, the how does it sound to you version. Let's look at some quotes. How do they sound? Very quickly. So recently in the FT, Mario Draghi and Emmanuel Macron talking about fiscal policy. They want to change the rules. Okay, they're too obscure and excessively complex. I can understand that concern. Importantly for them, they constrained the actions of governments. So the idea is, let's not get ourselves so constrained. Also in the article, they say we need to have more room for maneuver, and we need to ensure sovereignty. So we have a clear message, I think, from the member states. We want to have room for maneuver. We want to have sovereignty. We decide, and the rules are a problem. Okay, they are not currently escape clause anyway. The escape clause has been extended subsequently. The rules are going to be reformed. And now monetary policy says, obviously, we need to make sure that there's no fragmentation that would prevent the adequate monetary policy transmission throughout. I don't know. We have existing instruments. So your question was, what does it mean? Now, I understood that when we had OMT, right? The central bank wanted to ease financial conditions, but because of the debt crisis, spreads were rising so that it tightened financial conditions, right? So opposite direction. But now we're in a different situation. Inflation calls for tightening financial conditions. Spreads are also moving up somewhat, but in the right direction, right? Tightening. So it's not so clear. You have to think more what this fragmentation means. I guess it's not the optimal or not the same extent of tightness, what they don't like. So something like that. But I think it needs better explaining. They talks again about the existing instruments. They have already bought a lot. We just saw that in the picture. They can reallocate the reinvestments. They want to do new investments. So on June 9th, she had already said everything which was said now in the emergency meeting. Interestingly, on the next day, Governor Visco said, well, clearly for Italy, our analysis says a spread of less than 50 basis points is justified, 150 basis points. But if it's more than 200, it's definitely not justified. So at least there's a clear message, or kind of now okay, ECB needs to bring it down to 150 basis points or less by purchasing, right? By being a big demander. That's how you could read that. Maybe he said that in the meeting. Maybe that's why I had the meeting. I don't know. So let me close. We already have instruments, right? The S&P was used, but it was limited effective. We have the outright monetary transactions. They could be used. They have also been a judicial review. There are conditions attached. And so essentially, if there's any cause for worry, you could have exactly an ASM program and OMT. So that's why I said, why do we need a new program? Especially if President Draghi, when he was president of the ECB, said conditionality is very important. He said it reduces the moral hazard by governments. He said it protects the independence of the ECB. Made a lot of sense to me. So that's my only claim here, that to independence, apparently this is important. And he says without conditionality, you would certainly have what people call fiscal dominance. So fiscal dominance is a complicated concept. We can think about what it means in different models. Here at least we have along the how does it sound statement. He thought no conditions is fiscal dominance. So maybe the ECB should keep that in mind as they're now deliberating about this new instrument. And he says conditionality enhances things, enhances credit because it gives an incentive to pursue the right economic policies. So if there is cause to worry, I would think then we should use this framework. Particularly once it's signed, he also said it gets all of Europe behind you. So anyway, that's my comment there. There are potential legal challenges. Lars doesn't want me to talk about those. There's one thing I have to show. No, just one thing. When there was, because you were there, you were one of the expert witnesses, and so in the German Constitutional Court's judgment, they said here that in particular the purchase limit of 33%, the distribution of purchases according to the ECB's capital key, prevents selective measures, and that's why the PSPP is not unconstitutional monetary financing. So it sounds to me it's going to be very hard, whatever the new program looks like, it's going to have no purchase limits, it's going to have no capital key, and it's not going to have OMT-like conditions. So we're going to look forward to an interesting economic and legal interaction. And I'll stop here. You can see what I think should perhaps be kept, the current system, and not new instruments. But I'll hand over to the discussants. Sorry it took a little longer.
Yeah, thank you. Thank you very much, Volker. So, very happy. Started to discuss already, I became nervous just because we had two discussants, and I'm eager to listen to them before we start a general discussion. First of all, Lucrezia Reichlin will talk to us as the first discussant. Lucrezia is a professor of economics at the London Business School since 2008. Before, she was professor of economics at the Université Libre de Bruxelles. For 11 years, and then afterwards Director General of Research at the ECB from 2005 to 2008. She holds a degree from the NYU, and Lucrezia is well known in economics, in consulting, in political debates in Italy at the European level, in the UK. For example, she is chairing her own firm, the Nowcasting Economics Limited, where she develops nowcasting methods further, and also is helping.
From the Minister of the Economy.
For example, meanwhile, the Minister of Economic Affairs and Climate issues in particular. So you are doing this for many customers, and are well known in that regard. She is honored in several respects. So, for example, in 2021 by the Serena Medal of the British Academy, and she's well established in all Italian networks. And I don't know how many times you were mentioned as a potential minister or chairwoman of the Bank of Italy and so on. So, thank you very much that you came to Freiburg.
Thank you.
And, the floor is yours.
I mean, I guess I have the role of the Italian here in this very
ordo-liberal German audience, so you must immediately be very courageous to show up. So, and I'll try to do my best to at least open a discussion about Volker's view. First of all, let me say there is a lot I agree with Volker, although before the presentation I wasn't clear where it was going because I just looked at the simulation. But it is clear to me that we are facing a big challenge with inflation rising and the tightening of monetary cycles in a situation in which we have high public debt, not only because countries have misbehaved, partly is also that, but because we had two bad crises in the last 10 years, so we are sitting on a very high legacy debt. I think the challenge is driven by two factors. The first is that we're facing a mostly supply-driven inflation, so that for the central bank to have any hope, okay, to deal with that, they really will have to go hard, and that will induce a recession is the only way, okay, to deal with that problem. Of course, the issue is how fast, but this is not what I want to discuss today because this is not what Volker focused on. What the second issue, which is more going to be the focus of what I will say, is that whenever there is stuff happening in the euro area, in the monetary union, in the absence of a euro-denominated asset, in the safe asset, the sovereign market becomes structurally unstable. And this means that markets price a credit risk premium into the sovereign debt of some countries. We focus on Italy, Spain, and France, but we have seen tensions in the periphery in the past, and this is really only partly reflecting fiscal issues. It's the way in which market adjusts to shocks in the euro area. So the emphasis is really on risk premium rather than on steady state RNG calculations, which was the emphasis that Volker gave in his presentation. And I will return to these issues. But it seems to me that there are two views. One is that, I say Volker's view, that tightening is likely to imply fiscal sustainability problems for Italy, possibly Spain and France. The simulation presented some assumptions. It's always difficult to read the simulation because, of course, everything is endogenous. So you take as exogenous the IMF projection. So, this is. But it seems that in the simulation you're focusing on the path from here to 2035. So we should really, according to your logic, in translating on the RG, as you said, language, we should focus on the possibility that R becomes larger than G, in the long run. Okay, so this is only possible if the growth rate, the structural potential growth rate in Italy will be, in the long run, lower than the euro area overall, right? Because otherwise, R should be equal to G, the real interest rate in the long run in an efficient economy should reflect the potential growth rate. So we are talking about a situation in which there is a deviation because there is a stance of, the kind of monetary fiscal policies will have an R which is inconsistent with potential growth rate. So it's not clear how to interpret that. So, but you're not focusing on risk premium. Now, the other thing that you're saying is that, okay, but the situation may not be so bad, and if it's not so bad, there is nothing that we should do, focus on the fiscal discipline. And if the situation becomes bad, then we have an instrument which is the OMT, which is an interesting instrument because it's monetary intervention but with conditionality, and therefore the programs that benefit from that have to go in the program. Now, the alternative view is that the origin of the risk today is not really fiscal. Of course, public debt has, there are legacy issues, but we were on a good trajectory. The ECB is really facing a monetary phenomenon, which is due to the high inflation, which is largely imported. And then, the policy problem is to do tightening without inducing financial stability issues and disruption in the sovereign market. The good news is that the ECB now has many instruments, so we are in a very different situation than in 2012. So there is not just the short-term interest rate or the long-term refinancing operation, but we have had different versions of asset purchases. And they are now, all these different instruments are the stable part of the operational framework, so that the ECB can actually manage to target not only the short term, but the entire position of the safe yield curve, as well as to a certain extent accommodate sovereign spreads. In congruence with the price stability objective. Okay, so many instruments. Focus on the yield curve, which is nothing new. I mean, it's something that has been going on in the last 10 years, not just on the short end, but the entire yield curve. And to a certain extent, the cross-sectional element, so that, the ECB monetary policy, given the absence of the safe asset, has this type of double dimension. Okay, so the safe rate and the risk premium. Now, conditionality, like the OMT type of conditionality, addresses at the fiscal issues. It does not address these monetary issues. Therefore, we need a different type of instrument. Whether we'll have to come with a different form of conditionality or not is open to discussion, but is not exactly the OMT what it is what we need now. So that's the opposite position to Volker, and I think you probably it's obvious to you of which side of the argument I'm in. So that, but I also must acknowledge that these are difficult issues. So I will try to say something about how difficult these issues are. So the first issue is, of course, that the euro area is not a unitary system. So this makes the union prone to fragmentation. And again, here I'm talking about risk premium, so I'm not talking about the steady state RNG, because I assume that in the steady state R will have to be equal to G unless there are issues that I will discuss later. Now, as in 2011 2012, there is a lot of learning on how to cope with this problem of fragmentation and non-unitary in the current circumstances. So there are 4 issues, and I will not discuss all of them because I don't have time. So that, as you, I also have something on legal, but I will not discuss the legal issues. So that we'll see if something comes up in the discussion. The first issue I want to discuss. So how should we think about the debt sustainability in the current situation? Now, these debt sustainability calculations are tricky. Okay, as I said, in an efficient economy, the steady state RNG should coincide. But we know that there could be larger deviation for long periods of time, and where we come from, as you showed, is actually a situation in which R was less than G. And so we have to understand, so there was a premium, if you want, a safety premium that we enjoyed, and that is probably at this point gone. But it is not obvious whether it's gone or not. Okay, this also is endogenous to policy. So basically, Volker implicitly says, can we rely on that safety premium anymore with R less than G for a long period of time? Volker clearly says no. I say that we can avoid at least the R larger than G under some conditions. Now, the reason why R less than G has been less than G in the last decades is actually that the returns of private investment has been larger than the rate of government debt. So this is something which is possible in an inefficient economy, and this has created fiscal space. So, and if you want this difference, as this has been now emphasized in the literature by many people, Rollemeyer, Cathérine, and so on, this difference between the marginal product of capital and the interest rate represents a service flow of public debt arising from the same. So, this has been called a bubble term, or is a code, but more broadly, we should understand about this kind of this wedge as basically, something that the government can enjoy if the market thinks that the government is safe and that the government provides a set of credible policies. So that because, to the extent the market believes that government debt is desirable, then, you can rely on this premium. So the question today can be reformulated, and we should ask, what are the circumstances that can erode that fiscal space, that can erode the safety premium? And we know that different equilibrium are possible. And some equilibrium are compatible with increasing public debt for a long period of time without getting into sustainability problems, and some are non-safe equilibrium. And to the extent that we have non-safe equilibrium, we have to kill them. Okay? And that's what public policy is there for. So I would have wished that Volker put some emphasis on that, because this is not something that you can get in your simulation, because this is clearly something higher frequency, very unstable, because it depends very much endogenous to policy, is very much a link to what market expect about the coherence of the old framework, the monetary and fiscal frameworks that we have in the euro area. So, in fact, this leads to the question, what does it mean, this credibility, which is linked to the safety premium in the euro area? Well, it means to be credible overall, okay? So now, if we look at the history of public debt, for example, the work of Heidengreen, he gives three conditions for this, for being able to digest high public debt for a long period of time. The first is good governance, policy and institutions. So the limiting the bad use of debt. The second is the existence of legal control to protect creditors, or a clear framework of debt restructuring, for example. And the third is that the central bank should be known to be willing to act to stabilize its prices of government securities in case of liquidity crisis. Now, in advanced economies, there is no issue with legal contract, but there could be issues about the soundness of the governance and also on the perception of what the central bank is willing to do to stabilize the sovereign market. So, and fundamentally, we in the euro area, this issue doesn't have a very clear answer, right? Because we are not in a unitary system. So what the ECB does has distributional consequences, and this is why we are sitting on a very fragile situation, okay? So how to deal with that? Well, the first issue is to create a EU safe asset, okay? We all go together and get married. That's not possible for legal issues and for political issues, because it would imply a federal structure, which we don't have. There have been possible alternatives, okay? And you have mentioned some. One has been the S&P. The S&P has not worked. No pari passus, limited from the start, not backed politically by all governments. So, in other words, the S&P had no credibility, and it was a fiasco. The second has been the OMT, but it has never been used. It was the grand bargain in 2012. In a very different situation where we did not have QE, because this was not part of the framework, and in which we were in a fiscal crisis. So today, I think the origin of the crisis is quite different, as I said, and the problem is monetary tightening and the implications of that. I think to impose that kind of conditionality, ESM-driven conditionality, would be politically poisoned in a situation in which that kind of cohesion that we need, cohesion that would, would deliver a coherent framework, a combination of monetary and fiscal policy, is actually quite important to guarantee that safe premium. And also, I think that route should be very cumbersome to implement, and this is why it has never been used. So what else can we do? Okay, so what else, from speaking from the South, but I'm sure that this is something that, will be controversial, at least in this audience. In my view, the ECB needs to be doing whatever has to be done in pursuing monetary policy objectives with full flexibility. And this will imply using an appropriate mix of tools and their sequence, because when we're talking about titling, there is also an issue of what is the sequence of the use of the different instruments, because this affects not only the position of the yield curve, but also the slope of the yield curve. And maybe, okay, to make this suitable and also to make this stable, we should couple this with some form of conditionality, which, however, would not be like the OMT type of conditionality. But for example, we could say that these measures will be used only provided that countries are compliant with the conditions established by the NGO, which are monitored by the European Commission. So the advantage of this kind of milder conditions is that the ECB, will be judged for whatever is doing, so pursuing the primary objective of price stability. And the EU will exercise surveillance without putting a gun on the head or the periphery. And this actually, we have learned quite a lot about surveillance, especially in the context of the new instruments post-COVID. Of course, this is an uncharted territory. I know that it's not at all an easy solution. On the monetary side, there are issues on how to design, these anti-spread instruments, what kind of instability they will lead to, and so on. And on the fiscal side, a lot can be wrong. So, which leads me to, I don't know, probably I'll finish with the, the last point is, okay, so that if we do that, we may actually have fiscal risk, and this is not good, especially for the Germans, okay? So that maybe it's good for the Italians, but maybe not too good for the Germans, okay? So then the question is, fine, but this is probably unavoidable to make the system stable. So the question is, how can we deal with this credit risk in the Eurosystem balance sheet? And I think that today, this should be a discussion on the table. I tried to write it in several circumstances and discuss it with the ECB. I think that, the rules on central bank recapitalization are non-transparent. There are possible solutions that we discussed in the report that we did on the ECB strategy. But, it's important that we put rules in place at some time, not just in case, okay? Because even if expectation may seem small now, they could be larger in the future. And the second issue is that today there are very complex rules on risk sharing. And so these different instruments come with different rules, but ultimately what determines the extent of risk sharing is the relationship between the national central banks and their own government. So the rule of national central banks capitalization, recapitalization, dividend distributions determine the collective support of the Eurosystem. And it's very important to clarify these rules, to get out of this kind of constructing ambiguity type of attitude, which, because these rules and the fiscal backing of what the central bank is doing is actually at the root of the safety premium that we need to guarantee going forward. Of course, there are legal issues, but this I will not discuss.
Yeah, thank you very much, Lucrezia. Thank you. So, I think we started later, so we end up later. Let me introduce you briefly Cathérine Casanova, who is our second discussant on this topic. Cathérine is a senior economist in the Financial Stability Department of the Swiss National Bank. She holds a degree from Zurich University and worked for several years at the Bank of International Settlements in Basel. Today she told me she probably has one of the shortest travel needs from Basel or Zurich to Freiburg, which is pretty close. So thank you very much that you are here, and the floor is yours.
Thank you very much. This is great.
Yeah.
So, well, thank you very much for giving me the opportunity to comment on this presentation. These are, of course, my own views, and they should not be associated with the Swiss National Bank or the Bank for International Settlements where I was before. So in principle, this is better?
Yeah, it's better.
So the key question here is whether sovereign debt in the euro area is sustainable, and at the current juncture, what happens if fiscal and monetary policy normalize?
Something went wrong. Please try again.
Should I just start?
That was a comment on the European
I'll just continue from here. So the background is that the share of government debt over GDP have increased a lot in some of the euro area countries, namely, we saw this for France, Italy, and Spain, and also for some others, but declined for Germany. And very recently, we have seen this government yields rising. So this could be a sign of fragmentations, and we already discussed how to define it. But I think another problem or another question is that a problem? And if so, who's actually affected? And here, I'm not only talking about different countries, but actually about different sectors. So I think, of course, this is highly relevant and super timely. But what about the financial stability aspects? And I think maybe we should actually have a look at the euro area crisis, because at that point in time, banks were part of the problem. And there was a labeling during the COVID crisis that banks have been part of the solution. So where do we stand now here? Going forward, I will briefly comment on monetary and fiscal policy and basically on their interaction, because that's the main problem here. And then I'll briefly come to the banks during the COVID crisis and how the financial sector looks like right now. So the background, we know about the channels, but I think more important here is to look at the interactions. And in the discussion, but also in the chapter that Volker did not go into details here, some of this is actually mentioned, namely the interactions. And basically, what is very difficult here is when monetary policy and fiscal policy infringe on each other's territory. And that can happen if financial conditions tighten, or if you look at fiscal policy here, the main impact is on risk premium, because that has not only an implication for the government, but also for banks. When it comes to monetary policy, well, they impact the borrowing cost, and that in turn has implications for governments and for banks as well. When it comes to these interlinkages, we have already heard about these transfers between the central banks and the government, so there are transfers within the public sector. But that has always been the case. Now, it becomes more difficult when we think about QE and what has happened over the past years. Because now, the different balance sheets actually became more defined. So, in specific, if you look at these interactions here, after the crisis, and that applies not only to the euro area crisis, but also to the COVID crisis, these interactions or interlinkages have actually intensified. Why? Well, because QE is essentially a debt swap. And if you take the public sector at a consolidated level here, the asset purchases have effectively shortened the maturity of public debt, because long-term assets were moved to the central bank, and that means that overall the central bank is also sensitive to normalization. So let me come back to the banks and their role during the COVID crisis, and it was labeled as, well, banks during that period actually became part of the solution. Why? Well, because they were in between fiscal and monetary policy, and they were a key tool in transmitting different policy support packages. Initially, there was this huge demand for liquidity. Firms drew on their credit lines, so there was a need for liquidity. And then actually that happened before different policy initiatives were enacted. So from the monetary side, or from the ECB side, we saw the PEP, but we also saw the TLTROs. There are several ones, there are two, I think actually it's three. But there was also some regulatory relief being granted to the banks. And then from the fiscal side, we had different schemes as well, but they all interact, and I think that's one of the key here. So, and that happened at the different levels. So when it comes to the role of banks here, there was the idea to increase their capacity to lend and to lend to the real economy. That was done at a very high level. So there was liquidity being granted from ECB and, let's say, the euro area level, and also the regulatory relief was granted at this very high level. But then you can increase the capacity, but banks will not really lend if they don't have an incentive or any willingness to do so. And in that regard, the fiscal measures were very important because you might think about furlough schemes or the moratoria. They help to increase the creditworthiness of the borrowers. And then one of the key tools was the guaranteed loan schemes that several countries actually enacted. And that was done at a very low level, that was done at the national level, but it was very important to actually avoid a credit crunch. So the key message here is that overall the interaction of the different levels was necessary. And not only in terms of here, what you can see is from the supranational level and the national level, but also for the different kinds of policies. However, as we know, fiscal policy takes only place at the lowest level. So to some extent, this is already some kind of fragmentation. However, it comes at a cost, and the cost here was, of course, strengthening this bank sovereign nexus. And that means now going forward, that the unwinding also has to take place at these different levels, and that makes it very complicated. We've already seen some of it, but it's not, I mean, some of the schemes run out, or let's say for the guarantees, the loans are granted and the repayment schemes are very long term, but still, it's they are still on the balance sheet.
Excuse me, just to make sure that strengthening means not something positive, right?
No, definitely not. Strengthening in terms of the link becomes tighter. And that means exactly yes, and that has also implications now if we think about increasing rates, and of course not only increasing rates but also risk premiums. So this illustrates the reshuffling of assets and liabilities that we have seen. So there was a reshuffling of assets from the banks to the public sector. But then there was also this reshuffling within the public sector, namely among central banks and the government. I did not illustrate everything here, so the TLTROs, for instance, are the same. Now, going forward, where do we stand? And here I had a look at the latest financial stability review from the ECB. And well, their statement is that overall, as far as the asset quality is concerned, that's relatively stable. Capital ratios apparently have improved. When it comes to profitability, it's a bit more mixed because apparently banks learned to make money even in a very low rate environment, first of all. But, and this happened in parallel to what we heard before about the structure of government debt. They have also increased the maturity of their loans, and that's to some extent natural, but there is evidence, at least at the end of last year already, that they also increased their hedging. So to some extent, even if rates increased here, yes, they issued a lot of long-term loans, and if rates go up, that's not very profitable, but they have hedged part of this risk. And the ECB, here I quote from the financial stability report, at least they state that a normalization should not be a major concern. Yes, of course, there's heterogeneity among different banks, and of course those which have a very high interest rate exposure then are more affected. But overall, at least it's not a major concern. That's their word. Coming to the funding costs, I think that's probably more of a concern. Because already at the end of last year, bank bond yields also went up. And what's also true is that in the course of this year, there will be substantial repayments from the TLTROs. So banks will need to either shorten their balance sheet or they will actually need to refund that. And then, of course, refunding costs will have gone up. So the question is, are banks part of the problem again? Yes or no? So just to summarize, I think this is the financial stability aspect should be taken account in this whole discussion, because it also has implications for whether or not interest rates can go up or not, and it has implications for the risk premium that also the banks have to pay. And banks have been part of the problem before; they have been part of the solution during the COVID crisis. But the question is where we really stand now. And over the past, these interlinkages have increased a lot, even within the public sector, but also with banks now, given that the sovereign, the bank sovereign nexus has intensified or strengthened in terms of has grown. And the funding costs and the policy transmission, of course, that's probably an issue which is contributing to these statements from the ECB that we just saw.
Thank you very much. It's still working. So we, as I said, we started later, and I hope that Stephanie Schmitt-Grohé already agreed with our email that we start 15 minutes later with our talk. So we have some time for discussion. Who wants to start? We talk quite a lot, but well, we are not fully tired, so Francis.
So, Volker, to your
Well, you get a micro?
To your charts on interest payments relative to GDP. So you showed us if you use the current term structure, the ratio is more or less stable, nearly for all countries. But no, not that. The way you calculated. That. So the orange line, it's more or less stable for all countries. So this would mean in absolute terms, in euro billion, the interest payments would increase for every country. Is that true?
Yeah.
In absolute terms, they would increase. They would burden.
They grow with the same rate as the GDP.
GDP growth.
Okay, so this was simply a clarifying question. Yeah.
Volker, why does a difference in risk premium does not allow a good monetary policy transaction?
Transmission.
Transmission.
Well, that's why I thought things are different, right? So, I mean, we had this argument in the crisis when 2012, when policy was supposed to ease and spreads were rising dramatically. So right now we have a small increase in spreads, and we want to have tightening of financial conditions. If anything, the ECB is behind tightening financial conditions. So per se, it's not so clear that there's the same problem in the euro crisis as in the euro crisis, and that you now need to intervene again to manage these spreads.
No, sorry, Volker. One thing is the shift of the overall yield curve, another thing is the spread. So we want tightening, but we don't want to have excessive tightening in certain regions of the euro. I mean, that's the problem.
Well.
I mean, that's the transmission mechanism, because that actually transmits in financing conditions for corporate and households. Right, you may think that they deserve it, but that's the problem that they're facing.
I mean, I don't talk about deserving or anything. I mean, that's not the point. But I think Lucrezia just said it. She said, so what's really, they want tightening, but they want to prevent excessive tightening. So it's a different story, as I pointed out. But they want to prevent excessive tightening. That's what you just said.
We want the same tightening as in Germany, okay? We don't want an asymmetric tightening, which means that whenever there is a reversal policy, certain countries get it.
Okay, so
Exactly, because of movement of the risk premium, which are not justified, but fundamentally, that's the argument.
okay, but I'm not arguing. So Lucrezia said they want exactly the same tightening. I don't know how you achieve that and how you exactly measure that, but that's the goal. Okay?
They want to set the same risk, right?
The same risk premium? No, you can't set the same risk premium. They are there for risk premia. They don't want the risk premia to move. That's what you're saying.
We don't want the risk premiums to move more than what we justified as the fundamentals. Okay. So we have seen it in 2011, 2012, in which Italy was almost out of the euro area. That was something that we may want to do that.
Yeah. Okay, no, but I think we don't disagree. I think that's the desire. The desire is not to have an increase in spread. Right? And the solution is ECB needs a new program with minimal conditions, because the programs which exist are not politically acceptable. But I think that exactly shows you the problem. We're still in an experiment of multi-union. We don't know exactly, we don't have an exact agreement how this should be governed. Right? That's why there are also legal processes. But my point in principle was there exist sufficient instruments for preventing an undue rise in spreads. You can have an ESM program, and you can have it together with OMT. It has the advantage of being through all the legal challenges, so you can safely apply it if you want it. I take it it's not desired, which means governments actually don't want it. They don't want to be affiliated with the ESM. Even though, remember, during COVID, we had minimal conditions. We had ESM credit lines, which all countries could have drawn on. So if all countries would have applied for the ESM credit line, which was offered, then you could just now do OMT, because you already have an ESM credit line in every country. So I think, and then there would be no, there would have been no stigma or no toxicity, because every country would have the credit line. What's the big deal? But then you have a system which we have used before, and you don't have to experiment with new measures. The new initiative basically, to me, signals an unwillingness of governments to accept ESM-style conditions. It raises doubts about sustainability, if anything. In the new ECB initiative basically indicates that they make themselves responsible, and that's how I take your comment. Make themselves responsible of these spreads, so I think that's the answer there. And my question really is, the ECB already owns about 25% of the Italian debt, 45%, 40% of the German debt, 45% of the Dutch debt. How much more? What share is sufficient? That's the question one then has to answer. Is it going to be 50, 100? Basically, throughout the last 2 years, for all the countries, the ECB bought up more than was issued. So in net terms, there was no issuance to the market, because the ECB bought up more than what was issued in net terms. So we're basically, I think, very understandably in a situation where we have to find out under what conditions do markets accept any net issuance, because for highly indebted countries. Because the future says higher interest rates, no debt, no bond purchase program. So there's going to be net issuance. And so all this is not about spreads, it's just about finding out under what conditions at all markets would accept net issuance of highly indebted countries. I think there is a reasonable rate. That's what these, at least one get some hint from these calculations. But if not, then we have the instruments to deal with it, and we should use them.
I fear that we have to move on. So we have to continue this discussion tonight at dinner, and then tomorrow morning, and so on. Thank you very much again to all three of you. I think this was a really good start for the discussions that we're going to have, and no easy solution to everything that we would like to solve in this life.